Welcome to the NFO review series. I'm Rin Agarwal. In this video, I'm going to be reviewing the Nippon India Passive Flexicap Fund of Funds. It's quite amazing, but a lot of NFOs that I have reviewed in the last few months come with these incredibly long names, and I keep wondering how investors are ever going to keep up with these names. First things first, what is this NFO all about? Well, this is in the Flexicap category, which means the fund manager can be in whatever market capitalization they want, depending upon what market cap they feel is going to do better. So they can be in large cap, mid cap, and small cap, basically. Now, this is a fund of funds, and it is a passive fund of funds, which means that it is going to be investing into index or ETF funds from Nippon itself. And so they would have a combination of a large cap fund, a mid cap fund, and a small cap fund. And all these would be Nippon index or ETF. So Nippon Nifty index fund or the Nippon small cap 250 index fund. It could be any of the passive funds that they hold. What proportion are they going to hold these funds in? Now, this is where it's a little tricky. They are going to allocate between these funds basis the average allocation of all active flexicap funds into the industry. So essentially what they're trying to do is that they're really trying to follow the market in some way, because what they're saying is that based on what is the average allocation across other funds in this category, they're going to keep the allocation similar. The rebalancing is going to happen on a monthly basis, and the fund is benchmarked to the Nifty 500 Total Return Index. So should you invest? Of late, we have seen a lot of investors preferring passive funds like index and ETFs, but the mistake that most of them really make is that they tend to choose only the large cap index like a Nifty 50, and they really don't tend to diversify among other passive funds. This fund gives them a good opportunity to diversify among different indices. There is an automatic rebalancing between the indices as well, and there is no tax that is applicable on this particular rebalancing since it is done at a fund level. But the fund does have many disadvantages. The first and the foremost being the cost. The expense ratio is expected to be 1%, and then they would also be incurring cost on the index funds or the ETFs. Even though it's a very low cost, when you add all of it up, you're pretty much looking at this passive FOF having costs similar to any actively managed fund. The other big issue with this fund is that FOFs are taxed as non-equity taxation, which means that if you sell it below 3 years, it's going to classify as short-term capital gains, and if you sell it above 3 years, then it qualifies for 20% with indexation. My take, as an investor, you have different fund choices. You can go in for a passive fund, you can go in for actively managed fund where fund managers are investing depending on where they have high conviction in, or you can go in for a fund like this, which is going to give you passive investing along with the rebalancing. Given that the costs in this fund are going to be similar to that of an actively managed fund, but actively managed funds have better taxation, I would say go in for this fund if you're really clueless about what you want to do. If you want to invest, forget about it. You don't want to go in for active fund management, then probably this is a fund that you can consider. If you are able to evaluate funds better, keep a track of it, and do some rebalancing on your own, then probably choosing a combination of index funds or choosing an actively managed fund would probably be a better bet. Make sure you click on the bell icon to subscribe. We do look forward to your feedback. Till then, cheers.